Good day and welcome to the Softrax Executive Webcast. Today's conference is being recorded. At this time, I would like to turn the conference over to Bob O'Connor, President and CEO of Softrax. Mr. O'Connor, please go ahead, sir.
Thank you, Jamaica. I am Bob O'Connor, the CEO of Softrax Corporation, and we are the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today, and welcome. We have about 700 registrants for today's webcast, which indicates how much executives want to hear about today's topic from our two distinguished speakers. They are Ken Bender and Alan Sanzori of Software Equity Group, and they'll make their presentation entitled M&A Implications of the Consolidating Software Industry. Our audience today consists of CEOs, CFOs, board members, venture capitalists, VPs, accountants, and other corporate and financial professionals. I'd like to take you through the agenda here. I will spend just a few minutes talking about Softrax revenue management, how it relates to the M&A environment that we operate in today, and then turn the great majority of the session over to Ken and Alan, who will assist them to go through the topics that you see on your screen right now. For those of you who are familiar with our webcast, you'll know that a very important part of our webcast are the Q&A sessions that take place at the end of this. So we'll reserve about 10 or 15 minutes towards the top of the hour for your questions and answers. And again, it's a very important part of our webcast. All of this agenda will be done by the top of the hour. From a questions perspective, if you want to ask a question, please look and find the Ask a Question feature located in the lower left-hand corner of your webcast console. That's the only way we'll take questions with this many people. We need to do it over this platform. And I will be reading these throughout Ken's and Alan's presentation, and I'll ask them at the end of the period. The most frequently asked question is will you get, how can you get a copy of the slides? And after seeing their slides, you'll certainly want to get a copy of that. So the way we do that, we make you work a little for that, if that's okay. At the conclusion of the webcast, your browser will be automatically redirected to an online survey page. Complete the survey, and you'll be able to get the slides and a bonus report. We listen to these questionnaires. Recently, people asked for another session on M&A. That's why we're doing it. So we really appreciate your feedback, and you will not only get copies of the slides, you'll get a link for the on-demand recording if you want to listen later, and you'll get the 2005 Annual Software Industry Equity Report that these gentlemen produce. So those are the ground rules, and let me just take you through why we're doing this and something about Softrax and our products. We are pleased that our customers manage billions of dollars of revenue using our software. And throughout the U.S. and the world, several hundred customers in quite a few different industries use our products to manage their revenue, billing, revenue recognition, reporting, forecasting, and for other financial activities. And as you may know, Softrax started by developing software for software companies to manage these complex financial and revenue activities. And we are the dominant player in that software industry. As a point of fact, over the past 2 years, of all the companies in the technology market, such as software and software as a service companies who have gone public, well over half of them are customers of ours. So people use our applications to be the foundation if they're considering an IPO. And we also have many customers, as you can see from the screen, who are consolidators in the industry, acquirers in the industry who use our products as a platform to absorb other companies, and many customers as well who have been on the sell side and been acquired. From an industry perspective, over the past 2 years, and the slide indicates this on the left-hand side, you'll see that we have successfully broadened our market to reach and service the needs of several different industries, and this has been a major factor in the explosive growth that we have witnessed over the past couple of years. Industries such as business process outsourcers, business services, and information services, e-commerce, and so forth are among those. With pitchers and catchers reporting in Florida and Arizona soon, and for us in Boston, that's good news because it means that good weather's coming. We're happy to put this slide up that depicts the rivalry of the Red Sox and the Yankees, but it also depicts that revenue accuracy is the single most contested issue in an M&A event. And obviously our goal is to ensure the processes and the systems that allow for revenue accuracy. And certainly in the Sarbanes-Oxley world, whether you're the buyer or the seller, revenue accuracy is of prime importance. Sellers or people who are considering selling their company need to really act like a public company in terms of their revenue accuracy, transparency, and compliance requirements for those public companies that may acquire them. And, of course, needless to say, public companies are under a higher degree of compliance with respect to revenue accuracy, the auditability of their systems and processes and things like that. We certainly live in a world, as Ken and Alan will take you through, that is being consolidated in the software industry. In our cases, sometimes customers buy other customers of ours. And here's just a very quick quote, and this is really what we like to hear from customers, and then when someone is doing an acquisition or whether they're being acquired, our applications can certainly help them get a better handle on current and future revenue streams, deferred revenue, make things quicker and smoother, mitigate risks and write-downs, and allow acquisitions to go smoother. So we've certainly heard that from many customers. With respect to Sarbanes-Oxley and internal controls and 404, this study shows that the area that is most difficult to establish internal controls are revenue recognition and contract administration and management. Not surprising to anyone, I'm sure, on the phone, but two areas where we devote a lot of our time to help our customers with our products. And CFOs of public companies and private companies do not lack for challenges in today's environment. They have operational challenges in the areas of billing and operational efficiencies, managing contracts, subscriptions, licenses, renewals, things like that. They have compliance challenges, whether it's Sarbanes-Oxley or the many issues to deal with revenue recognition. And they have financial reporting, visibility, and forecasting challenges as they run their business and report to their investors. And our solutions are closely aligned with these challenges and provide the following value benefits. Our billing and operations efficiencies deliver great value to our customers in decreasing their costs and increasing their revenue. Our revenue recognition and compliance applications enable real complex. We've been in this market for a long time. We have very, very deep knowledge of the complexities of revenue and expense accounting in light of ongoing regulatory issues, and also visibility, the ability to better understand your business performance and not only just past but future performance. And our product lines support these three value propositions. We have billing and operational products that help with contract management, complex billing, order management, renewal management, things like that. We have very deep applications, deeper than anyone in the industry, with respect to revenue allocation, revenue scheduling, revenue recognition, expense accounting. We've heard all the pronouncements and work with them very closely to make sure that revenue is properly allocated and recognized. And business analytics, revenue analytics for visibility into business performance and forecasting. And it should be noted that people can buy or license any or all of these independently. And they are also complemented by financial applications, professional services automation applications, and reporting applications. In a recent survey, we were pleased to learn from our customers that they really gained a great deal by improved compliance, that their efficiency as an organization, as you can see in this chart, improves about 50% in many areas, from contract management to billing to maintenance renewals to revenue reporting and things like that. And in many, the great majority, again, improved customer relationships as people need to manage those relationships from a billing perspective and so forth. So our goal in life is to help our customers increase their revenue, decrease their costs through operational efficiencies, while all the time making sure they comply with the latest and greatest regulatory issues. So that concludes my comments. I did want to introduce our guests and hand the show over to them. Ken Bender is the Managing Director of Software Equity Group. He founded the firm in 1992. Before that, he had operating experience as the Vice President and Chief Administrative Officer of Microwaves, which is a Fortune 500 systems integrator. He was the President and CEO of Access Solutions. Sorry, Ken. And he's been honored many times, including Software Industry Leader of the Year from the Arizona Software Association. He's a much sought-after speaker, and we see him on the road speaking all the time at conferences, so we're delighted to have him. He is joined by Alan Cesori, and Alan is a VP with the firm and one of its fastest rising stars. He's been in the business for about 8 years. He also has some operating experience with Solar Turbines and other companies, and he really conceived of and designed and authored the annual Software Industry Equity Report. Again, that's the report that we'll give you as a result of filling out the survey, and that's read by by about 4,000 software industry executives, including me, on a regular basis. So welcome to Alan, and we'll turn the program over to Ken.
Thanks very much, Bob. It's a pleasure to be here this morning together with Alan. I think we're going to take our audience through what has been referred to in the industry as a tsunami of consolidation. But there's much more here than meets the eye, and I think in the next 35 minutes or so, our audience will see that. I'd like to briefly introduce the audience to Software Equity Group. Although many of today's attendees, about 700 or so, are familiar with our firm, I'd like to briefly introduce Software Equity Group to those of you who may not know it. We are regarded by many, fortunately today, as the software industry's leading boutique investment bank. We're a 14-year-old firm. We've provided advice and guidance to more than 1,000 private and public software companies on 5 continents. Our reports are read now in 26 countries by more than 10,000 public software company executives, VCs, private equity investors, investment bankers, and service professionals. And that's the commercial. What we're going to do today is just a snippet of what's occurring in the industry, and as we speak, literally, in the software M&A environment particularly. For more information, you can visit our website, download our 2005 annual report. There is a fee for that report. It's $295. I think you'll find it well worth the money. Our quarterly reports are published for free, and you can get those usually within 25 days or so after the close of the quarter from our website. It's likely you'll have some questions today that you won't have an opportunity to ask during the webcast. And so we encourage you to contact us at the contact email addresses listed on this slide, K. Bender at Software Equity or Ace and Zori. And we would welcome those questions and respond promptly to you. Let's begin by discussing how 2005 has set the stage for software industry consolidation in 2006. And to do so, we'll look briefly at 3 distinct but contributing factors which have a very real but not necessarily obvious impact on software industry consolidation. The first is that public software companies in general, and we'll talk about what we mean by in general, have had rather lackluster financial performance. Actually, the financial performance hasn't been bad, as you'll see in a minute, but it certainly had tepid public market response, lagging market caps, and that in itself has created a phenomenon which is contributing mightily to software industry consolidation in the current environment. In this slide, you'll see that what we call the SEG 100. It's an index of actually 104 public software companies that we track and follow. They represent at least 5, and in some cases many more, software companies in all of the product categories you'll see in a couple of slides. We track them as a category, we track them individually, and then we publish that data as an index, which we call the SEG 100. You can see that in 2005, the SEG 100 has lagged the NASDAQ and has also lagged the S&P 500, certainly from a market cap stock price standpoint. And so what you're seeing here is a lack of investor confidence in the software industry. And yet financial performance of the SEG 100 was really quite positive. This slide coming up seems rather daunting, and I'm not going to review all of the data in these tables, but what you'll see here is that the median trailing 12-month revenue for the SEG 100 increased 12%. So that's an incremental compound annual growth rate in 2005 over 2004. Median EBITDA margin of the SEG 100 grew 16.6% in the first quarter to 18.5% by the fourth quarter. hardly a huge growth. But yet, if you look at this table and you look down that last column on trailing 12-month earnings growth, you see tremendous earnings growth in many of the key product categories of the software industry. And I'm going to address that in a second. IT capital spending increased a modest 3%. And we think there is a very significant downstream effect between IT capital spending and revenue growth. That's pretty obvious. But a less obvious downstream effect between IT capital spending and M&A activity and M&A valuation, which you'll also see in a few minutes. Solution providers, software developers in categories that were top IT spending priorities showed by far the strongest growth and the highest valuations in the public market. Web tools and storage management software providers led all other software categories in terms of revenue growth. Supply chain, ERP, and middleware lag far behind. I'm going to leave it to the attendees at a later point in time after the webcast to kind of look at this data. I think you'll find it very interesting and hopefully insightful in terms of understanding VC investments, valuations, and the like. But what's the problem with these numbers? They really don't look too bad. Earnings growth is more than decent here, but earnings growth is not enough anymore for the street. If you look back historically at our reports and the data over the last 2 or 3 years, software companies have squeezed more and more earnings out of fewer growing revenue dollars. And the street has lost confidence in the ability of many public software companies to grow their top line. As you'll see in the upcoming slide, what we've done here is to demonstrate that the street really wants and the street really rewards growth. And in this scatter graph that you'll see in a second, what we've done is taken the key product categories in the software industry and mapped their median enterprise valuation and their trailing 12 months revenue growth. The dark blue you'll see are what we consider to be low growth software sectors, software product categories. And the light blue are what we characterize as higher growth based on trailing 12 months revenue growth. You can see there's a very good correlation between the valuation of these public software companies and their trailing 12 months revenue growth, notwithstanding the fact that many in the what we call the low growth or slow growth product categories have had very, very good earnings. It's revenue that the street is demanding right now. So in 2005, and we believe in 2006, even more so, the public markets rewarded and will continue to reward top-line growth. That has profound implications for software industry consolidation and M&A. With few exceptions, revenue growth translated to higher valuations, and so we took this arbitrary line at 12.5% compounded annual growth rate, and we divided them into slow growth and high growth software product categories. Why? Well, as you begin to look at the numbers, you're going to see some very significant implications of being a public software company in one of those categories or the other. Remember now that we're looking at 12.5% compounded annual growth as the dividing line. The message in this slide is that product category is a major determinant, that may be the major determinant of public software company stock market performance and certainly downstream M&A performance, as you'll see. If you look at these high growth versus low growth category performance in 2005, remember that left-hand chart is high growth companies in the security, business intelligence, web tools, storage management. You can see that they had very impressive trailing 12 months earnings growth. They had solid but not stellar trailing 12 months revenue growth. They built their cash reserves by about 20%, and they improved their valuation reasonably. In those low growth areas, and these are medians, of course, but if you look at the companies comprising the SEG 100 for supply chain, ERP, CRM, and those categories that were dark blue in the prior slide, you'll see that they worked mightily to push up their earnings. They continued to take out costs, reduce headcounts, improve productivity as a way of trying to gain investor confidence. And that was the low-growth strategy. They squeezed everything they could to improve profitability, but they couldn't grow top line, and investors noticed. And they're noticing more and more, and that also is driving what you're about to see in software industry consolidation and M&A, this clamor for top-line growth. Cash and cash equivalents from the beginning of the year to the end of the year rose very, very modestly, and you'll see that enterprise value of these low-growth category software companies declined from the beginning of the year to year end. The message, again, is that few people are looking at the street perception of particular software categories and the impact that's having on the software companies, on their valuations, and on their M&A strategies. So the takeaways from this first look at public software companies is that public software companies are under unprecedented pressure to show top-line growth, but growth today is largely a function of software product category, which in turn is driven by IT capital spending. So let's take a look at the next contributing factor very briefly, which is the IPO market. And the IPO market, I think it's best to say, is comatose. You're going to have to look hard to take a look at the IPO market, because there are virtually none. So what's the impact of that phenomenon on M&A activity and on exit valuations as well? You see that most investors and owners of private software companies have no viable near-term path to liquidity in the current market. IPOs fell 9.2% overall amongst all industry sectors. There were 10 software IPOs in 2005. There were 16 in 2004. Software companies raised in aggregate $872 million. They raised $3.7 billion the year before. Software IPOs, however, those that were strong enough and were daunting, were able to confront the daunting challenge of going public, and maybe they were self-screened on that basis, they were able to post a 40% return at year-end relative to their first day of trading. But today, the IPO pipeline, the last time we looked, which wasn't too long ago, was 4 relatively unknown software companies. And one of the reasons for this, is that Sarbanes-Oxley, new stock option rules, are having a very, very dampening effect. Study we just read said that the average cost of compliance for a small-cap NASDAQ company for Sarbanes-Oxley compliance ran between $500,000 and $600,000. And so the IPO market and that form of liquidity for investors and owners and entrepreneurs of privately held software companies has essentially been foreclosed. And so the takeaways here is that there are very few new buyers with IPO proceeds to spend on acquisitions, very few small and mid-cap companies, or fewer small and mid-cap companies to feed the behemoths, and more small and mid-cap private companies willing to give up on the IPO dream and consider some other factors. We'll look now at what's happening in the venture capital community, which is the third contributing factor here. You'll see in this next slide that the vast majority of software companies remain undercapitalized. Venture capital investing has gone safe, and it's remained safe, and venture capitalists are seeking greater leverage by investing in later stage and expansion stage companies. 2,992 companies received funding across all industry sectors, up a mere 3%. Dollars invested were relatively flat. VCs allocated more than 80% of invested funds to expansion stage and later stage private companies. Software, as it has every year for the last 4 years, has led all other industry categories with 863 companies which were VC funded. That's 22% of the total. VCs invested $4.9 billion in software, just about almost exactly the same as they did in 2004, which does not bode well for small early stage and seed stage software companies. So the takeaway here is that there are more small and mid-cap private companies with no ready path to liquidity. More investors are becoming anxious for near-term liquidity and don't believe they're going to get it in the IPO market. There are other investors who have plenty of money, and there is plenty of money out there, and patience, but what they want to do is bulk up and get ready for the IPO market when it does turn. And so they're exploring a very different strategy they're exploring an M&A strategy too, but very different from those investors seeking near-term liquidity. So all of these three converging factors, public software company performance, the lack of an IPO market, the VC investments remaining rather nil in comparison to certainly the bubble days and even prior to that in the late 90s, is having a downstream impact and has set the stage for software industry consolidation in 2006. On the M&A front, what's really occurred as a result of these phenomena, and what are we dealing with here? Well, the first thing to look at is what the effect has been of the consolidation to date. Our count shows 316 public software companies, and just look at that list, were acquired over the past 4 years. A total of 47 new IPOs, software IPOs, occurred over the same period, and many of those were not viable. You have a substantial decrease in the number of public software company buyers out there. And if you look at some of those companies, and we have, most of those companies were reasonably acquisitive prior to their being acquired. And so the net impact of this over the last 3 or 4 years has been between 750 and 1,000 transactions that would have occurred in all likelihood based on prior history, but didn't as a result of this plethora of public software companies being acquired. And that's had a real impact in the current M&A scene. So in understanding how 2005 has set the stage for software industry consolidation in 2006, there are significantly fewer established public buyers, significantly fewer new public buyers, significantly fewer candidates to become public buyers, and yet deal volume has not declined precipitously, nor has it increased nearly as much as the industry pundits and the press would have you believe, that there's this flurry, this tsunami of consolidation. There was a 5% increase in 2005 over 2004 in terms of M&A deal volume in the software industry. That's good, and it's particularly impressive in light of the fact that you've gotten all of these public software companies taken out of the market, which otherwise would have been acquirers. So how is it then that deal volume actually grew modestly, but all of these purchasers kind of left the scene? Who's made up the difference? What's happened to the buyer mix out there? And this next slide indicates that financial buyers and repeat buyers have taken up the slack. There's a changed buyer mix right now. There's an unprecedented number of private buyers. In 2003 and in 2002, you'll see an average of 21 to 24% of the buyers out there were private buyers. And that increased to 37% in 2004, 33% in 2005, and we think will come in at about 35% in 2006. Who are they? They are, for the most part, venture-backed private companies, $20, $30 million, where the VCs who are sitting on a lot of cash would like to put more money in to those companies to get ready for the IPO market, very ready for the IPO market when it changes. And they want to fill gaps in their product line, and they want to grow revenue to be deemed more viable by investors when the IPO market opens. And there are direct investments by VCs and private equity firms, more management buyouts occurring now, but those investors, those private equity firms are tough, and they're still value-minded, and they're not throwing money at in these management buyouts. We can tell you that by personal experience. On the bottom chart, you'll see that in addition, who's taking up the slack are repeat buyers. IBM, which did 4 deals in 03 and 6 deals in 04, did 12 deals, software deals in 05. They actually did 15 if you count hardware and services. You can run down this list and see that there are a growing number of companies that are becoming highly acquisitive in the current marketplace. In terms of M&A valuations, you'll see that $74 billion was spent on software M&A in 2005, which was 42% greater than in the prior year. But don't forget that 10 of those deals were each $1 billion or more. The median software valuation based on trailing 12 months revenue grew every quarter over quarter, and ended the year at 2.6. And the problem with median software valuations is that everybody then takes that, every software entrepreneur of a privately held software company we know takes that median number, multiplies it by their trailing 12 months revenue, and that's what they're worth. Couldn't be further from the truth. This is our favorite slide of this presentation, and it looks a little busy, but let us take you through it, because I think, and really this is a seminar in itself, and we'll spend a couple of minutes on it. We scrutinized almost 700 software M&A transactions over the past 2 years, virtually every one that reported where a revenue multiple valuation could be calculated. And you'll see that the median multiple of 2.4x based on equity value, we took all those deals, 24% of those deals were public sellers, 76% private sellers. The median multiple is 2.8 equity value, 2.2 times trailing 12 months enterprise value. In other words, deducting cash and adding debt, which we think is a far better assessment of valuation. But the interesting thing here, going back to this category kick we're on, is that if you divide that 24% into software companies in low growth categories versus high growth categories, look at this. 16% of those 24 were low growth public sellers. The median multiple on an equity basis was 2.3, with 2.0 on a enterprise value basis. But those in high growth categories, twice as much, were able to sell for twice as much because of, I think, in very much part, because of the categories that they were in and the growth that they were sustaining. Don't go down yet to that bottom set of to the bottom of that chart. Move over to the right with the pie chart. You'll see that private sellers had a 2.8 median multiple. They represent 76% of the total. In low growth categories, they had a median multiple of trailing 12 months revenue from an M&A exit standpoint of 2.1 in low growth categories. But those in the high growth categories, almost twice as much, 3.5% in high growth categories. These are private companies in high growth categories that are exiting. The moral of this first part of this slide is that that median multiples mean virtually nothing in the current marketplace. The first thing is, what space are you in? Because that's going to have an awful lot to do in determining what your likely exit valuation is going to be. The other thing that's going to have a tremendous amount to do with what your exit valuation is going to be is who came to the table, who are you, how big are you, and who came to the table to buy you or is interested in buying you. So if you move down to to the bottom of that slide.
Ken, before we do for a second, just for clarification, we're getting a bunch of questions on this. You talked earlier about the categories and what category they're in, and if it's high growth or low growth.
Yes.
There's a bunch of questions coming in. So if I'm in a low growth category, but I'm growing faster, does that make me a fast grower or a slow grower? And if so, what percentage annually in terms of revenue growth would be fast versus slow?
So if you're looking at CRM, I'm going to flip back, at least in my slides, to if you look at CRM and you're looking at compounded annual growth rate of maybe
under 10.
Considerably under. Or supply chain, where your compounded annual growth rate is probably 2%, but you're growing at 10%. The message here is that you are bracketed. If you're growing faster, your investment banker should be able to negotiate a better price on the basis that you stand out. But don't think that you're going to move into the valuations of an internet tools, a web tools company or a security software company. Your category is going to act as a ceiling on your ability to exit at a significantly higher valuation. So yes, you can be more profitable than the average. Yes, you can be growing faster, but beware that the category you're in, the buyers who are interested in that category, the prices they were willing to pay, even for a faster growing company, are going to be pretty constrained.
And generally, just to go back don't move back to the previous screen, but some people ask the question. Generally speaking, the low growth categories are growing from 0 to under 10%, and the higher growth are growing 10, 20, and more.
We arbitrarily, and you can argue with it, and this isn't science. We arbitrarily drew the line at 12.5%.
Okay.
And we did that not just based on the numbers, but based on a variety of other factors as well, valuations and deal activity and what we were seeing in the marketplace. But that's kind of where we drew the line. We analyzed all the companies in that category, took the median, and determined whether that category was a high growth or a slow growth. But what we didn't even anticipate was the data we're showing you now. What a profound impact that has on downstream M&A valuation.
Right. So I want to clarify that. So that sounds great. That helped a lot in terms of where the category and not so much the company in the category. And I wanted to get that straight because it's such a powerful slide that I want to make sure that people get that. And I'd also remind people while I'm at it is feel free to ask questions by clicking on the Ask a Question box, and we'll answer Ken and Alan at the end of the presentation. So sorry to interrupt. Ken, back to you.
Okay, and I just want to finish this slide. I suspect many of you will spend a lot of time, I hope you do, on this slide. Bigger buyers pay more. Bigger sellers sell for more. In each category, although if you compare high growth and low growth, sellers greater than $100 million in low growth, 2.9x on an equity value basis, 7.1x on a equity value basis for high growth public sellers. A little less dramatic on the right-hand side. In low growth, sellers greater than $20 million, 2.3x. Sellers greater than $20 million, 3.7x. Take a look at this, and you'll see concomitantly, buyers greater than $200 million paid 2.9x, even for low growth companies. What's happening here? What does this slide really mean? I want to harken back to what we said earlier. There is this drive for revenue growth, and buyers are willing to pay for it. But they're not willing to pay in high growth and low growth categories the same kinds of valuations. They're constrained by the market and how the market is treating them. And they're not going to treat public or private sellers a whole lot differently. So the valuations are going to change, but the deal activity is still going to be, in both sectors, rather significant. Here's a slide that we almost tossed. David Legacki, who is one of our top financial analysts and put this data together at my request, we came in and we looked at this and we said, well, there's a lousy correlation here. This slide isn't saying anything. And I almost tossed it, and then I said, it's saying everything. What you have here is the response of these various product category groups to this incredible demand for top-line growth, and how some of them are frozen into inaction. In the supply chain and ERP, this graph, by the way, on the y-axis is showing M&A deal volume, and on the x-axis is showing trailing 12 months revenue growth. what you're seeing is that there are some companies that are just incapable. They don't know what to do, how to reposition. They're thinking the market will turn around. And actually in the CRM arena, it's beginning to have some indications it might. So certain of these product categories are not buying anything, relatively speaking, and they're frozen. Some of them are looking to reinvent, to expand their product categories into others. I call those resurrection. CRM is one of them. Some of them have just been cautious. BI does not do a lot of acquisitions. They did a few. They were very key acquisitions that allowed them to morph into business performance management from strictly BI, but they're not doing a lot of add-on acquisitions. The fast-growing guys in security and web tools are out to differentiate. They're doing a lot of acquisitions to plug holes, expand their suites, differentiate from the others in their space. Storage management, which has grown tremendously, has decreased its M&A activity. We think that's a process of digestion. Here, too, is a slide you may want to refer back to in terms of the M&A activity, notwithstanding how some of these sectors have been pummeled, the M&A activity in these sectors, because they're reacting differently to the challenges of the market. In this next slide, what you're going to see is when these low growth versus high growth companies do acquire, predictably, the high growth companies do pay more. So you have M&A valuations based on a multiple of revenue on your y-axis and your median trailing 12-month revenue growth by category on your x-axis, and you'll see that the high growth companies pay higher multiples. If you look at the average and you look at the median, than low growth companies. So take those two past slides and extrapolate. You have in some sectors that are low growth sectors, if you're a privately held software company or a fairly stagnant growing publicly held software company, and you're looking to exit via acquisition, you have decent odds depending on the sector, but you don't have unlimited valuations. If you're in the CAD/CAM CAE arena, which is really now product lifecycle management, there's a decent chance you'll be acquired, but it's likely that you'll be acquired at a 1.5 to 2x. If you're in the security sector, that actually went to 4.7 in 2004, but decreased a bit in 2005, and we think will decrease further in 2006 a bit, although the sector will remain very, very active. You'll see that the faster-growing companies tend to pay more, predictably. That not necessarily do more activity, because the slower growth comes in certain categories are plenty active, but they're not paying nearly as much. And for the privately held software company entrepreneurs on the line right now, you have to understand that your chances of selling are good. But if you are a supply chain company, or you're in some of those low growth sectors, or CRM, and you're looking for a 4x because you're growing at 60%, or you've got a 55% EBIT, you will probably be unable to attract that kind of offer unless it's very happenstance, and those happen, but relatively sporadically in the current marketplace. Let's move on. Now we get the prognostications, and frankly, we read a lot of industry pundits, and we read a lot of the industry analysts, and we actually go back in prior years to see how accurate they were and how accurate we were. And we're not too accurate, and we're more accurate than they were in many cases. But here's our prognostications based on, I think, some pretty intense analysis, but take it with a grain of salt. We actually predicted pretty accurately on median valuations and deal volume last year, but we'll see, based on the next two slides at the year end, how close we came. So who will grow and acquire and spend more in the year to come? The bellwether, we've always believed, is IT capital spending. We look at that in terms of its downstream effect almost more than anything else. We like the Goldman Sachs report. We follow them all. We find Goldman Sachs, as we go back and actually assess what actually happened, is very, very accurate. And so the source of much of this data on this slide is Goldman Sachs, with some rework from us as well. So if they're wrong, don't blame Goldman Sachs, blame us for doing a little bit of rework. But security will remain a top priority in 2006, but a shakeout is clearly in progress. Application integration will be a priority. By the way, what you're looking at here is a few hundred, that's not a bad sample, top Fortune 1000 CIOs who actually talked about how they're going to spend their money in 2006. And that's going to severely impact public software companies, and it's going to impact M&A as well. And so you'll see that application integration ranked relatively high. But interesting, services-oriented architecture did not rank high. And high-buzz technologies, which everybody's talking about, will capture the industry, such as server storage virtualization, software as a service, and open source, ranked relatively low among these CIOs as spending priorities. And we think that will have unquestionably a downstream impact on software industry mergers and acquisitions in 2006. Our final slide, who will grow, who will acquire, and who will spend more in the year ahead. And this is our projection of 2006 M&A activity by category. We worked long and hard on this, and we're probably wrong on a number of these. We've been surprised before, but here's our take at it. The obvious, we think that from a M&A activity and M&A valuation standpoint, security, systems management, compliance risk management, that Sarbanes-Oxley compliance, particularly in the financial services software sector, and risk management software sector and in vertical software sectors, is finally having a pretty significant impact on software company purchases, on enterprise purchases and software company performance, those for providers in those sectors. Web tools remains very hot and active. Mobile computing probably should have been higher on the list. We see it as a very top category. Business intelligence will remain as a solid performer. Media, entertainment, and games, we think will remain, will grow in M&A activity and interest. Data management and the like. Less obvious, we see retail vertical as not done yet. There have been a number of, including Oracle, number of acquisitions in that arena. We see CRM coming back a bit. We see a typical curve there, and what happened is it saturated the marketplace. Enterprises spent a fortune more than they intended to. The ROI was not what it was intended to be, much like ERP in the late 90s and early 2000s. But it will, we believe, begin to come back now from an M&A valuation and from an M&A activity standpoint. You can run down this list. We do not believe that storage management, which everyone is touting, will have very high M&A activity. We think there's a digestion going on there, and 2006 won't see a lot of that. We see ERP continuing to struggle, developer tools, and you can look at that. Essentially, we're projecting a modest 5 or 6% increase in M&A deal activity in 2006. That's a nice number of deals, historically speaking. Certainly more than 98 and 99, not nearly what it was in 2000. And we are showing a modest decrease in valuation for all the reasons we just spoke about in 2006 to a median valuation, which I just told you is relatively worthless, to 2.4x trailing 12-month revenue. That's our presentation, but let me remind you, this is absolutely the tip of the iceberg. Our annual report is, I think, 67 pages of this kind of analysis and data, and we invite you to visit our website if you want more information on that regard. And we'll turn it over to you, Bob, for questions.
Thank you, Ken. That was great. There's been a lot of questions, and I'll first say that a lot of questions had to do with where do I fit, what category am I in, and we just can't get to those. I apologize. In the interest of a very large group, I think we have to deal with broader topics. Another question that has come up is how can I get copies of the slides? How can I get a report? I've given that instruction before, and I'll give it at the very end, which will be in about 10 minutes. Okay. So, Ken and Alan, let's talk about the business models within your framework. A lot of our new customers are on-demand models, software as a service, recurring subscription, nice revenue, deferred revenue streams, and recurring revenue streams. There's a lot of adoption of our products in that marketplace. In a category, does it matter whether they're a kind of licensed, classic license maintenance model or a subscription or software as a service recurring model with regard to valuation or attractiveness?
I think we need to do a separate seminar on that, but let me give you the...
I'll give you a minute.
Okay. I think the answer to that is it very much depends on, does it matter? Yes, it matters a great deal if you're a public software company. It matters a great deal if you're a private software company seeking to be acquired in the next 12 to 18 months because buyers want that. The street wants that. And we spend a lot of time in our annual report on this issue, really looking at it. So everyone wants it except the end users. And if you look at the CIO interviews and the analyses, it's pretty low down. What we believe is that software as a service, as a leveler of revenue and an enhancer of EBIT, is a good one, but it will not be the vanilla flavor for everyone. We think that probably in 5 years from now, 25 to 35% of the market will be of end users and enterprises will be wanting and clamoring and on that platform. Many will want to retain the traditional model, although they'd like it priced and done differently. And so we do not see software as a service quite as the tsunami that others do. But the street wants it, investors want it, pundits want it, and acquirers want it because the street wants it. So we encourage privately held software companies to adopt it as quickly as possible, understanding that their business model is going to transition over probably far more slowly than anyone anticipates, and in certain sectors, perhaps not at all.
Okay, when you said they want it, you're talking about the recurring model.
I'm talking about the recurring license.
The subscription, okay.
Subscription model. Bear in mind that the average privately held software company that's been in business for 10 years or more is already deriving 30% of total revenue from recurring maintenance and support revenue. But that's not enough. The street wants to level out the license revenue blip.
Got it. Okay, that's helpful. A lot of questions also, Ken, on earnings versus growth. And obviously, you've talked a great deal about the acquiring companies wanting to drive the top line. And what advice do you give to a private, I'm kind of munching a few questions here, a private company who may want to exit at some point in the future in terms of investing in the top line versus making sure that there's enough to the bottom line to be attractive, to be accretive, and so forth?
Hey, Bob, this is Alan Sindori. I'll go ahead and address this one.
Please.
I think really what that has to do with is really what category you're in. If you're in a more traditional category, such as ERP, which is more of the slow growth category, a lot of the acquisitions that are going to take place in that space are going to be based on EBITDA metrics. And that has everything to do with the fact that it's a more mature industry. If you're in more on the high growth side, what these buyers are looking for is validity, that you have the ability to serve the market. And one way of getting that verification is through high market adoption and high revenue growth. So it depends on where you are in the market space and exactly what category you're playing in.
Okay, so the answer to the question is they can look at the report, find themselves in a category, and at least gain some insight from that.
But it also has to do with who's come to the table. Financial buyers, which you saw are 34 to 37% of the buyers who are likely to approach you or may be interested in you, are looking for rapid growth. They also want profitability, but it's a little less important to them, but they will use the profitability as leverage in the valuation negotiation. But if I had to choose for a financial buyer, they're looking for very fast top-line growth, but they also want reasonable profitability. Strategic buyers are looking for product fit. They don't want to buy companies that are going to be dilutive, but they are also looking for top line growth with some reasonable profitability.
Could you expand? There are some questions on the financial buyers, and obviously I think people all see them as much more active in the marketplace today. Could you expand on a profile of a company with respect to size, growth rate, profitability that may be attractive financial buyers, and by exception, people could rule themselves out if you could just
Sure.
some type of model.
We've had a number of clients out and that we've presented to, I would say, a dozen and a half of the top financial buyers out there, where we've gotten down to final negotiations. So we've had a lot of experience very recently in this. So I think Alan can talk to that well.
So, Bob, I would say that when you look at the private equity community and those buyers, I personally think that one of the most important factors for them is looking at what is that profitability. And in most cases, it depends. It's for the tier one private equity buyers. They're going to want to see somewhere in the neighborhood of at least on a minimum 10 to 15 million in EBITDA, which is quite significant. So that means that these guys are doing very large deals. And that has everything to do with the fact that they're big private equity firms that mainly are doing a lot of these deals out there. They're taking large private companies or large public companies private. So I think when you're looking at it, you've got to be, do I fit the picture? You've got to be fairly sizable to really attract the large tier one private equity firms.
But in addition to that, you've got to be in a space with huge market opportunity. So if you're in bovine veterinary software and you're growing your top line and you're profitable, it's not going to be of interest. And I mean huge space. Even if Gartner is following it and they think the space is really going to catch on in the next 5 years, it's not enough for them. They want to know that there's unlimited growth potential in this, if it's a platform company, in doing this acquisition.
And I think one other thing that I could possibly add to that is that what I just described, as well as Ken, is we're looking at a platform company. There are many cases where these private equity buyers acquire a platform business and then they're looking for bolt-on acquisitions. Now, all of a sudden, if that's the scenario you find yourself in, I think you need to, while the financial buyer may be the guy who's cutting the check, you need to look at yourself as being acquired by more of a strategic buyer, because they're looking at that platform company that they bought, and they're looking to do bolt-on, add-on, very strategic product enhancement acquisition.
And in that case, if you're highly strategic, whether you're growing 15% or 30%, whether your EBIT is 6% or 20%, is going to be much less important than whether you plug a hole in your best of breed in what they need to flesh out their suite.
And just so you've talked about some good-sized companies. There's a lot of questions here about the smaller companies. What's a $5 million company to do? There's concerns that about how they could fit in and drive a lot of revenue growth and therefore get a good deal of value. So what's the smaller company to do?
We certainly know and deal with a lot of them. It's in the current marketplace, it's a real difficult question.
And by smaller, I think the kind of comments I had, like 5 million or 6 million, or under 10, I think, were the questions were around.
I think capturing market. I think revenue growth is absolutely key. Most small $5 million software companies really haven't figured out sales and marketing. It's a huge expense to them. They're afraid of it. The CEO is on the plane most of the time. They're growing 10% a year, and that does not attract industry interest from larger players. They've absolutely got to remain state-of-the-art, and that means Ajax for the next year, and it meant 10 years ago, it meant 32-bit from green screen. But they've absolutely got to remain state-of-the-art. That's very hard to do when you're capital constrained and bootstrapped, like the vast majority of these 30,000 under $10 million software companies out there are. But if they don't, they will not be acquired under any circumstances. They believe they will. They'll tell you, many of them, they'll tell you that their customer base doesn't care that they're not state-of-the-art, doesn't want them to be state-of-the-art, but the acquirers do. So there are two thoughts. You've got to grow. You've got to figure out this sales thing. And you've got to remain state-of-the-art in terms of your technology.
Okay, great. Well, we're up against the clock. We had, I think, 100 or so questions, and we certainly couldn't get to all of them, but I appreciate our audience for their participation, their questions, and And again, you'll get the report here. But Ken and Alan, thank you very much for sharing your experience and insight with our audience. I'm sure they found it of enormous value. I certainly did. And I say to everybody, please stay tuned to our websites, your emails, our websites at Softrax.com and RevenueRecognition.com for future events such as these. Again, we value your feedback, and a lot of people ask questions, how do I get copies of the slides? How do I get the report? So as we speak, your screen will be directed to an online survey page. It's there now. Please complete that survey. That'll get you access to the slides. That'll get you access to a link for an on-demand recording if you wanted to listen to this again or share with a colleague. And we'll also get you, as Ken and Alan have said, the very valuable 2005 annual software industry equity report from Software Equity Group.
It's really just a summary.
Just a summary. Okay. Well, I've got it here. It looks like the whole report.
No, but it will be a good summary of the slides plus some additional data. The report can be purchased and downloaded.
Okay. My apologies. Okay. Thanks for clarifying that. And again, Ken and Alan, thank you very much for your time, and thank you to everyone. Bye-bye now.